Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Rob Almeida, Global Investment Strategist at MFS Investment Management, to discuss the role of the financial markets. Rob, it's great to have you back with us. Welcome to Trade Talks.
Thank you. Thanks for having me.
And Rob, my question to you is, has the financial services industry become overly complicated in the past number of years?
I think it certainly has. If we think about what's the value proposition of capital markets to society, it's pricing risk, allocating capital, allocating resources efficiently. And over the last 100 years, but really specifically the last 30, 40 years, it's just gotten really complex between different asset classes, different options. But at the end of the day, it's just one asset class and it's risk.
Yeah, and I think part of that issue is, and we're seeing this in the COVID-19 environment specifically, weaker balance sheets, income statements, earnings kinds of seems a bit fuzzy. I mean, if you look at Q2, the beats were good, but what's your baseline?
Well, I think the beats were definitely good, but what kind of visibility did we have 3 months ago? What kind of visibility did we have 4 to 5 months ago? And even that, what kind of visibility do we have now? And so I'm not going to anchor too much to the better than expected earnings. I certainly welcome it, but I think just longer term, ultimately it triangulates back to what's the return that businesses are generating. And I think if you look at what asset prices are discounting, if you look at earnings estimates for the market in aggregate in 2021, this is a tremendous amount of, I think, hope embedded in asset prices. And I'm not sure hope is a really good investment thesis end of the day.
Do you think capital should be allocated more responsibly then?
I definitely think it should, particularly over the last several weeks. You've seen stocks of bankrupted companies accelerate. We've seen asset prices rise. You can argue it was off of better than expected earnings, but I think when you decompose what's working and what isn't, I'm not sure if that's the case. But I think if we just take a step back and we just compartmentalize risk or compartmentalize vol, there's asset classes that do well when expectations that things are going to be less volatile, stocks, corporate bonds, credit, et cetera. Then there are asset classes that do well when we expect more volatility, US Treasuries, gold, et cetera. And over the last 2 to 3 months, both are going up together. So that, to me, is more indicative of an investor base, really, where there's just too much supply of capital chasing too few or too little demand.
So then what's the answer there? How do we get back to some sort of normal in the financial markets?
Yeah, well, eventually water finds its right level and it's not too pleasant of an experience. So I think for the more prudent investor, I think you just need to be a lot more thoughtful and careful with asset selection and issue selection, and just really not try to anchor to yesterday's noise or yesterday's data point, and to think at the end of the day, am I being compensated for pro-cyclical risk? I think the answer to that is no. And so investors just should be, I think, a lot more thoughtful and careful with how they're allocating their capital today.
So let's talk about the longer term outlook, because it's easy to get caught up in the news cycles and values in one day because big tech has run up so much, and we're looking at gold and the gold trade and everyone hopping on that. I mean, there's a number of trades that have been out there over the past 4 months that you can argue have really been herd mentality kind of trades. So when you look longer term out at MFS Investment Management, you are longer term managers. How are you advising investors to look towards the other side of COVID-19, perhaps Q1, Q2, 2021?
Yeah, a couple things that we're sharing. So more in the nearer term, I think investors are forgetting that profits are not linear. Profits are exponential. So if we think about what COVID has done, at least to me, I think it, one, exposed the weak fragility of balance sheets. So it exposed just the leverage profile for corporations around the world. And that was why you had that liquidity squeeze in February and March. And the second thing it's done, in order to keep employees and customers safe, it's pushing up costs for every company. So what we have is now more leverage than what we had 6 months ago. What we have now are higher costs than what we had 6 months ago. And what we have now is a revenue base that has not returned to 2019 levels. So when I calculate those together, it's just really hard for me to compute an aggregate earnings that's going to be superior to what we saw in 2019, because you can open 80, 90, 95% of your stores, movie theaters, airlines, whatever it may be, but absent 100% of that capacity returning, you're just not going to get the scale and the operating leverage that you used to. So that's why I think markets are a bit over their skis right now. I think more in the longer term, what we're telling investors is no different than what we've told them for the last 100 years, which is it's about durability of the franchise. So what does the company do? How do they do it? And can they keep doing it? So when you think about what comprises the valuation of a stock or a company, it's really just three things. It's what's the return on the business, what's the growth rate of those returns, and what's the risk of the business. So I think if we're somewhat agnostic on growth versus value or tech versus healthcare, and just think, what does this company do within this industry that its peers or competitors can't copy or can't duplicate? Chances are that probably leads to an above average return, an above average growth of return, and below average risk. And generally, those are pretty good assets over time. And that's how we think about things.
All right, Rob, appreciate the insight. Thanks for joining me on Trade Talks.
Thanks for having me.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.